I'm hearing lots of questions lately about the housing market and discussions about whether we are in a housing bubble that's about to pop. So let's just talk about it. We have all watched with eyes wide open as home prices have gone up over the last few years. The average sales price in Clark County was $487,000 in 2020, and it rose to $571,000 in 2021. And now in 2022, it is $587,000. So we are seeing it happen. We all know that. Personally, I sold a house in Camas in 2019 that in this market would go for well over $800,000. That is not what we sold it for, so ouch, I get it, it hurts a little bit. For years now, I've been hearing buyers say they're just gonna wait for the market to cool down. They have been waiting, they've been waiting and waiting, and homes just keep getting more expensive. The homes are appreciating at a rate of 17 to 20% per year. So, are prices gonna come down? Is it something worth waiting for? And what if it never happens and you're still a renter in 5 years? Wait around until the end of this video where I'm gonna walk you through a sell versus rent calculator to show you how these numbers shake out over time. There's been one time in this country when homes lost significant value. That was back in 2008. We saw homes lose value for two reasons. First, loose lending standards. People who really should not have qualified for a loan were getting loans, often with adjustable rate mortgages, and it was a recipe for disaster. The second issue prior to the bubble bursting in 2008 was cash out refinances. People were applying for loans that they didn't qualify for and then taking out equity in their homes, and then their homes lost value and they couldn't pay off those loans, they walked away. When these things happened, homes lost value. So what is ahead for us? The Federal Reserve raised the federal funds rate in May. They did this to take the heat off of high inflation, which includes real estate home prices. According to Kiplinger's latest forecasts, the rise in the Treasury's 10-year yield rate will push up mortgage rates from the current average of just below 5.5% to near 6%. Let's take a quick historical perspective on interest rates. The first year Freddie Mac started surveying interest rates was in the 70s, when rates ranged from 7 to 12%. In the 80s, inflation was on the rise and the Fed funds rate pushed mortgage rates to an all-time high of 18.45% in 81. By the early 90s, rates came back down into the single digits and dropped below 7% in 98. Rates jumped back up above 8% in 2000. They remained in the high 5 to low 6% range for the rest of the decade. In November of 2012, rates dropped to a record low of 3.35%. For the remainder of the 2010s, rates stayed in that low 3 to 5% range. The first 2 years of the 2020s were a roller coaster ride, with rates dropping to new historical lows, followed by one of the highest spikes in inflation since the 80s. COVID pandemic began. The Feds cut the federal funds rate to almost zero in order to stabilize the economy. For 2020 and 2021, rates stayed between 2.7 and 3.1%. In March of 2022, inflation increased by 8.5%, the biggest spike since the 80s. As of May 2022, rates have risen to the mid 5% range. So looking historically though, it's really not that bad. Now that we have some perspective on interest rates, let's talk about appreciating home prices. The most recent updated home price forecast from 7 respected forecasters believes, on average, 9% appreciation in 2022. That's nationwide. The year started off with about 5% appreciation and has risen slowly every month since. Buyer demand is still strong. So many buyers are still in the market looking for a home, and the number of homes for sale is still incredibly low. As a homeowner, if you are still in the driver's seat, and your home's value is going to continue to increase, just at a little bit slower of a pace. Side note, if you're a homeowner and you're thinking about selling and you want to leverage the gains that you've made in your home ownership, I am happy to speak with you about a market analysis for your home's value. I also have a great tool called HomeBot. I can give you, it will send you regular value updates via email. Just let me know if you're interested and I'm going to get you started on that. As a buyer, buying a house is a great way to hedge against inflation. With a fixed rate, you will always know what your monthly payment will be. On the other hand, rent payments typically rise each year and are expected to increase 7% this year. Another reason to purchase in this rising market is that as a renter, your rental payments are just putting your money into your landlord's pocket by paying down their mortgage. Homes are still increasing in value, so if you buy now, you will still be able to capture the rising equity and value in homes. Let's take a closer look at that using a rent versus buy scenario. Let's say you are currently a renter paying $2,500 a month for rent. You are considering buying a house and your budget would be around $550,000 and you have 10% to put down, $55,000 to put down. If you buy, your payment is going to be around $3,600 a month. Also, don't forget that when you own your home, you are able to write off the interest that you pay on your loan each year. If you take that savings into consideration, your tax adjusted payment is just over $3,100 a month. Your break-even point is a year and a half. If you choose not to buy, then in a year and a half, you will have already spent that much money on rent anyways. If you stay in that house for 3 years, you will now be $90,000 ahead in value versus just dishing out $96,000 in rent. Just saying. Let me know if you have any questions. As always, I'm happy to chat with anybody interested in moving to the area. My contact information is in the header above and also in the description below.